Hello, I'm Pat O'Hare, Chief Market Analyst for Briefing.com. Today is Wednesday, March 19th. Briefing.com CEO Dick Green has posted a new big picture article that you won't want to ignore. Why? Because he uses facts rather than fear to explain why the U.S. economy will manage to avert a recession. To this point, Dick discusses the export boom, which is the great untold story of this business cycle as the media obsesses over the housing issue. As it so happens, the dollar volume of exports is 3 times as large as the amount spent on housing construction in the U.S. economy. It is 3 times as important in the GDP data. A dollar of exports counts just as much as a dollar spent building housing, but housing is getting far more publicity. This is understandable as a large percentage of Americans are affected by housing, particularly in the form of home prices. But in terms of analyzing the overall economy, it is horribly wrong to ignore the impact of exports. Here are some facts. Exports in the fourth quarter GDP were at a $1.731 billion annual rate. Exports are up 13% over the past year. Residential construction, by comparison, was at only a $584 million annual rate in the fourth quarter. The real trade deficit is falling. This is partly due to the surge in exports, but it is also due to the lower level of imports. The lower level of imports means that for every $1 spent by U.S. consumers, a larger percentage is going to U.S. firms. As a result of this improvement in the real trade deficit, the net export category of GDP has actually added more to GDP than the plunge in housing has taken off. That is worth repeating. Net exports have had a larger impact than housing. The net export contribution will also be large in the 2008 first quarter data. The January real trade balance was down sharply. Given the weak dollar, a further improvement is likely for February, and one for March is also probable. The contribution to real GDP in the first quarter will likely be about 1.2%. Separately, industrial production is holding up surprisingly well given economic conditions. It is yet to decline as in past recessions. In fact, prior to the 0.5% decline reported for the month of February, the index was at the record level it set back in August 2007. There are reasons to believe that manufacturing will hold up well in the months ahead. Exports will remain strong. Also, the backlog of unfilled manufacturing orders is up over 4% the past 3 months and is at record levels. That will keep production from falling sharply, if at all. The lack of a sharp decline in manufacturing, such as occurs in recessions, matters. Note, we're not talking about manufacturing surveys here, but rather actual production. Moving on, the equipment and software business investment component of GDP is over twice as large as housing. It has been up 4% in real terms the past year and has contributed an average of 0.34% to real GDP the past 3 quarters. The fact that manufacturing shipments were up 1.1% in January suggests that this category of investment will be up again in the first quarter. Now, housing and credit problems deservedly get a lot of attention. There's no reason to ignore the negative trends in the key sectors of the economy. Ignoring the positives in the economy at the same time, however, is a bit like saying the New England Patriots won the Super Bowl 14-0. But the Giants did score 17 points and thus count, too. In football, the positives and the negatives are always clear and the final score is what counts. In the economy, it is equally wrong to only count the negatives such as housing and to ignore the net export category or business investment in equipment. It all counts. That is why it is in the GDP numbers, and the numbers to this point add up to a gain in real GDP. That is largely due to the fact that the January real trade deficit data suggests that net exports will add 1% or more to the quarterly change. Housing will take off a similar amount, offsetting that positive. But the housing component gets full recognition for weakness, while exports get little attention. Overall, the first quarter GDP components add up to a small positive. That means economic conditions are bad, but still not recession bad. The boom in exports deserves a lot of credit for keeping real GDP in the positive column, and it deserves far more attention than it has received. To read Dick's full article, place your cursor on the Our View tab at the top of the page and select the big picture, which is the 4th page listed on the drop-down menu. I'm Pat O'Hare for Dick Green and Briefing.com. Thanks for listening.